Okay, so our session today, like I said, would be policy, which happens to be the first for international tax. We hope to get it interactive as possible. So along the way, we're going to pause and then have your views on a number of things, really. So for today, we're looking at international tax. Based on, oftentimes will be based on residency rule. What do we mean by that? In other words, what we mean is if you reside in Nigeria, we expect that you contribute towards the development of the country through taxation. So your residency for most countries been a key rule around setting their taxation rules. So you'd expect that, okay, you work in Nigeria, you typically pay your payee to the government because you reside in Nigeria and you work in Nigeria. You establish businesses in Nigeria, so because you're in Nigeria, we expect that you would support development in Nigeria. However, currently the world is a global environment. It's a lot of where you stay doesn't really matter really when it comes to any revenue or generating the issue of international taxation. So try to understand what the impact of globalization and technology has had on international taxation. Border transactions that are subject to international taxation. And then we'll take a look at tax policy. So looking at what are some of the guiding principles around international taxation that we should be aware of. Establishing laws around international taxation. We then look at some of the key terms, really. We define some of the key terms that are important for this class and going forward. And then we then look at double taxation as well and the digital economy. So let's go straight to the course for today. So, like we said, where you stay, where you reside, doesn't really have any much impact on where you earn your revenue from. So someone could be in Nigeria, for example, but they could be generating all of their income from, say, the US. As an individual, maybe they're doing freelancing. As a business, maybe they have a fixed base out of those countries. They're providing consulting services to people in those countries. Or people outside of Nigeria as well could also be offering a lot of services to Nigerians. They could be selling goods to Nigerians without actually residing in Nigeria. So it therefore shows that the concept of globalization has really meant that countries should take a look at their tax system and say, okay, how do we earn revenue out of the opportunities that come out of this global market? And one of the key issues about cross-border transaction is the fact that there is no single rule that guides all cross-border transactions. In other words, there's no single rule that says, okay, if I am in US and I am doing business in, say, Ghana or Nigeria, these are the specific tax rules I will comply with. There are no definitive international tax laws that apply to every country. It therefore means that each and every country will then decide on the tax to impose on its residents, as well as the tax to impose on those that are not its resident but that earn money out of the country. So and that's where the concept of international taxation comes in, and they need to have rules. There is, however, an exception, and that has to do with the European Union. We know that in the EU, they have a set of rules that govern transactions between all countries in the EU. But except that, all other countries have to establish their own tax system. And the focus, like I said, will basically be on residents as well as income generated from cross-border transactions. And so international taxation then seeks to address some of the issues and challenges that comes from the different tax laws. So for example, you residing in, say, Nigeria, So we have our tax laws. But someone is not residing in Nigeria, he's residing in the US, but is actually earning income from Nigeria, maybe through providing online services or things like that. Earning income from Nigeria, they would also have their own tax laws as well. But then, because this income is generated between countries, it's important to be able to establish rules to gain some form of income from the taxation, from the income that's generated from your own geographical zone. So when we say international taxation, in summary, what are we basically referring to? We're basically referring to the set of rules and principles that govern the taxation and of individuals and businesses engaged in cross-border economic activities. That's the key concept. That's what international transaction is all about. Taxation of individuals and businesses engaged in cross-border economic activities. You are in Nigeria, earning income from outside of Nigeria, that is outside of the borders of Nigeria. International tax would apply to you. So the part of international tax would apply to you. You don't reside in Nigeria, but you earn income from Nigeria. International tax would apply to you. And so that's why sometimes you have e-commerce social media sites such as Facebook and Twitter would have these debates around, oh, you're earning income from Nigeria because we have a number of Nigerians that make use of these services. But you don't reside in Nigeria. You don't have a tax, you don't have a base in Nigeria. You don't have any head office in Nigeria. You're not incorporated in Nigeria. But because you earn income in Nigeria, you're then subject to international tax laws. Now, taxation generally, we know that there are basically two broad groups of taxation, and this also applies to international taxation as well. So we're basically looking at taxation of income. If you make any form of income, any form of profit out of jurisdiction, outside your home country, or in your home country, but you don't reside there, you need to pay tax on them. What are the rules around that? And those are the concepts the international tax tend to address. There are also things around transaction-based taxation. Transaction-based taxation. So when we say transaction-based taxation, what do we basically refer to? Who wants to give that a try? We're on level 2, so we should be familiar with some of these terms. So let's make it a little bit interactive. So when we say transaction-based tax, I'll explain what income-based tax is. You earn income out of a country, you have to pay tax as someone that is generating that revenue or that profit. But then there's what is called taxation on transactions. Who wants to try that? What does that refer to? Okay, yes, please. Yinka, please go ahead.
Yes, transaction based on international tax based on transactions simply means a person currently in overseas and the person in Nigeria. So the transaction that goes between the individuals or the individual companies is taxable following the international rule that binds the both countries.
Okay, thank you very much. That's a good attempt. So let's break it down. So like we said, let's assume that someone runs a Facebook ad. So you have a business in Nigeria. So you have a Nigerian business that runs a Facebook ad. So generally, you're going to make some payments for this ad. So Facebook will generate income. So as you make this payment, Facebook will generate income. So that income that is generated by Facebook is subject to taxation. So that is what we refer to as income-based taxation. However, you that is benefiting from that service, you would also pay what is called a consumption-based or transaction-based tax. Example will be VAT. Example will be VAT. So as you're paying your ad fee, you add an element of VAT to it, which comes to the government. So that VAT is linked to that transaction. it's linked to you that is making that payment. But the other guy that's receiving the income as well would also pay an income tax as well, which for a business, that would be your capital income tax, the CIT. And then you that is paying, you pay VAT, and the guy here would also pay CIT. So these two forms of taxation are applicable when it comes to international taxation as well. So what are some of the examples of cross-border activities that might warrant international taxation? There are quite many, but let's group them into three main classes. One is cross-border trade. You are in Nigeria. But you actually sell goods outside Nigeria. You make money outside of Nigeria. So in Nigeria, you generate your income outside, either in form of you selling goods or you're offering services. So some people do freelancing in Nigeria, so they reside in Nigeria, but because they do freelancing, they offer some form of services outside of Nigeria, so they earn income. So that income that you earn should be subject to taxation. On the other hand, you could be outside of Nigeria. In other words, a business is not registered in Nigeria, you don't even have an office in Nigeria. But then because it's a global village, you sell your goods and services to Nigeria. So you earn income from Nigeria. So those goods and services that are bought or sold between two countries will be subject to taxation. Now, there's the key problem around this then, because like I mentioned at the outset, is the concept of residence, which is the concept that which is an overriding principle of most countries. So it means that wherever you reside, you pay tax there. So if you reside in Nigeria, you pay tax in Nigeria. If you don't reside in Nigeria, wherever you reside, you pay tax in that country. So that's the first concept of taxation. Now there's another concept of non-residence. Another concept of non-resident. In other words, you don't reside in that country, but you earn income from that country. So that could be in the form of income earned outside your country. So you discover that you see that as a residence, you pay tax. Non-residence, but because you earn income in another country, you pay tax. So there's the risk that you could be subject to double taxation. You're subject to taxation where you earn the cash, and then when you bring the cash to your own country, you're also subject to taxation there as well. So that is the concept of double taxation. The fact that you could have your income tax in both areas. So international tax would seem to ensure that while there is no income leakage, tends to minimize the possibility that this could happen. So transaction of goods and services across countries is subject to international tax. Another one is foreign investment. Number of foreign direct investment that comes to Nigeria. Number of people that invest in the Nigerian Stock Exchange, and you call it Nigerian Exchange Group right now, they don't reside in Nigeria. The foreign investors, they don't reside in Nigeria, but they derive income from Nigeria in form of dividend, in form of interest on their bonds and the like, in form of capital gains. They derive income from Nigeria. So those core income are subject to taxation. But don't forget that is a concept of the fact that they might also still have to pay tax where they reside. So that's what some of the things international tax seems tend to address really. So that's the second group of economic activities that falls within international tax, investment income. A third is international employment, especially with the concept of remote work. With the concept of remote work. If you work in Nigeria, it's very easy. You work in Nigeria, you stay in Nigeria, it's very easy. At the end of the month, your PU will be deducted and paid to the state internal revenue service. But what happens if you stay in US, or you work remotely in, say, Shell, Nigeria. You work remotely in Shell, Nigeria. So let me ask the question back to the class. So who should benefit from your tax? Or who do you think the tax should be paid for? On your view, who do you think the tax should be paid to?
If the person works in Nigeria, although the person lives abroad, the tax should be paid to Nigeria. So this is where the income is generated.
Okay. So the tax should be paid to Nigeria. But then, don't forget we said at the onset of our class that there's a concept of residence as well. So most countries would say that wherever you stay, you must pay tax then. So if you are in Nigeria, regardless of where you work, you need to pay tax. Now, and there's some other countries will say, yeah, but you're earning the money from us. And even though you don't stay in Nigeria, but you're earning the money from Nigeria. So the concept of what? Non-resident earning income. So you could see that there's that risk when it comes to cross-border transaction, that when somebody works abroad, they may be subject to taxation in both their own home country and the country where they are employed. And basically then it will depend on the tax law of each jurisdiction. So for example, if you're in US and US say, as long as you're in US, you're going to pay tax on your worldwide income, which is what the US, for example, employs. Unlike in Canada, it's based on where you generate the revenue from. But in US, they tell you that, oh, you earn income on your worldwide earnings. So it therefore means that even though you earning this income from Nigeria and you need to pay income to Nigerian government, because Nigerian government would say you're earning income from Nigeria, so pay tax to us. It therefore means that when you take that money back to US, you would also pay tax in US. And so some of these conflicts between laws is what international tax tend to address. So that we have this, we try and minimize the possibility of international tax. Because it won't be funny if you're paying, say, an effective tax rate of, say, 18% in Nigeria, and then you're going to US and you're paying 20% or thereabout, or 30%. So what's now left for you, really? So those are some of the challenges we need to take note of as we look at international tax and the different tax treaties, and how these different tax treaties tend to address some of these concerns. So why do we need to have international tax rules? We've addressed some of them before, but then let's look at some of them again. Objectives of international tax rules. So why don't we say that, okay, if we're charging pay in Nigeria, everybody should earn the way we charge tax to everybody in Nigeria, everybody residing in Nigeria, is the same way we should charge tax on anyone who earns income out of Nigeria. That's because of some of the challenges I've just mentioned, including the issue of double taxation. So because of that, there's a need to have international tax rules. And there are certain objectives why we should have those rules. One is prevention of tax evasion and base erosion. So those are two concepts: prevention of tax evasion and base erosion. So who wants to explain this concept? What do we mean by tax evasion and what do we mean by base erosion? Let's hear your thoughts, because that's one of the objectives of having international tax rules. Yes, Inka, please go ahead.
All right, thank you so much, sir. Talking about the prevention of tax evasion and base erosion, simply let me just take the first one. That's tax evasion. Tax evasion is a criminal offense by an individual that is meant to pay tax. The international tax look at how to prevent against that and bring them to the tax net. Why base erosion is an individual trying to shift profits from an active a jurisdiction that will definitely earn you to pay tax to a country that you may likely not pay tax or pay less? Thank you, sir.
Thank you very much. Thank you very much. So we said evasion, refers to it's illegal. I'm basically looking at non-payment or underpayment. Non-payment or underpayment. So let's take a typical example. We typically do what is called self-assessment in Nigeria. In other words, the companies are required to declare to the government how much they earn in the course of the year, and then they then pay tax on that. Now the problem with the ease for Nigeria, for example, is the fact that if you declare wrong transaction, we could always refer to a bank statement. You could always say, taxman could always ask your bank statement. You could always send secularization letters to your customers, your vendors, to determine the value of a transaction. It's a little bit easy. But for international tax, take Facebook, for example, that does digital transaction. How do you determine how much Facebook is earning from Nigeria? You tell them to self-assess, there's a risk that they will come and tell you that it's just a little portion of their income out of the total that they earn out of Nigeria. So they deliberately try to conceal or misrepresent the income payable, especially when they know that you have a high tax rate. So they might just say, okay, yeah, we earned 100 billion, but just 1% is from Nigeria. But when in essence, you have much more than that, because you actually have these issues around the fact that you don't have access to the data they have over there. So that's the issue with tax evasion. You don't want to pay. You're looking for a way to reduce and not pay by possibly misrepresenting information. But when we say base erosion, we're saying you're looking for how to shift your profit. You're looking for how to shift your profit. So what's an example of how companies typically shift profit? What's an example of how companies will typically shift profit, really? Very correct. Through transfer pricing. That's one very, very key one they do. So some of them, it's when they buy from you, they add a huge amount to it. So if, for example, the price in the open market is meant to be, say, $5, they'll be selling to you at, say, $10. But in doing that, they're able to move that profit somewhere else so that you don't pay tax. And because you don't have access to that data, you only have access to data in your own country, it becomes difficult to track. And so one of the objectives of having this international tax rule is that it helps us to establish guidelines and cooperation mechanism to combat these practices and ensure that taxpayers pay their fair share of taxes. So there are two concepts I want us to understand there around one of that objective. One is it helps us, we're looking at guideline and cooperation mechanism. In as much as you don't have access to data around certain transactions for a foreign company, any money from Nigeria. The same thing in Nigerian company, any money abroad, the foreign company might not have enough data around some of those transactions. So what countries will typically do is to establish a form of MOUs, a form of cooperation that allows for exchange of data, exchange of information. And that data, that information helps them to establish certain guidelines that would ensure that they're able to get taxpayers to pay the right amount of tax to them. And there is a fair distribution of tax between the various jurisdictions, both where taxpayer is resident, as well as where the income is earned. So these are the two things we're looking at. And doing that, we're able to maximize, in taking this approach, we're able to maximize our tax revenue. So that's the first objective of international tax rules. It helps us establish guidelines and corporations. Secondly is to avoid double taxation. We'll talk a lot about this. Residence is a key issue. Most countries will tell you that wherever you stay, you must pay tax to that country. But then when you where you earn the money from, they also tell you you must pay tax because you're earning money from our country. So there's a risk that you pay tax where you're earning the money from, that you also pay tax where you're residing. But when we have rules, international tax rules that looks at both laws between countries, you're able to reduce the possible impact or the likelihood of double taxation. And so most countries, when they develop international tax rules, to avoid double taxation, they try to look at certain relief mechanisms incorporated into the international tax rules. So they could have, for example, tax treaties between countries. So both countries would say, okay, transaction between your country and my country, this is the approach we want it to take. These are the specific rules governing the transaction between country A and country B. And that helps to minimize the impact of double taxation. Second thing is foreign tax credit. So some countries would say, okay, if you've paid tax in country A already, when you bring the income to country B, which is a residence, we will give you tax credit for what you have already paid to country A, where you earn the money from. So that helps to reduce the impact of double taxation. There could also be things like exemption in terms of, okay, some would say, we don't charge you until we only charge you for money you brought into the country to spend in the country. So any money you didn't bring into our country, we tend to exempt it from taxation. So these are some of the mechanisms and one of the reasons why we should have international tax rules. Because once people experience double taxation, once individuals and companies experience double taxation, what do you think will be the possible impact? What will be the possible impact when people experience excessive double taxation? Let's say your thought. What do you think will be the possible impact?
Yeah, next profit will be,
Sorry,
less.
Okay.
Their profit will be less, their net profit. And the shareholders will get their dividends will also be less.
Okay, that's one advantage. That's one disadvantage. Second disadvantage right now for us in Nigeria, we're looking at we need to bring in FX. So if you're telling someone that, okay, why not render your services to companies abroad or export your services abroad or your goods abroad so that you can earn dollars, so that we can then bring back dollar into our country and boost, make dollar available, and then that will possibly strengthen the naira. But this guy knows that if I take these goods abroad, I'll be charged taxation abroad because I'm earning income from that country. See, I'm going to be charged taxation there at 30%. And then because I reside in Nigeria, and we've said that the overriding rule for most countries is residence. Wherever you reside, you must pay tax to that country. That is the rule, the default rule. So I pay tax when I move my goods out on the income because the country will definitely want to charge me. And then I bring it back to Nigeria, I pay, let's say, another 30%. So it therefore means that of my total profit, what I will have left for me will just be 40%. In other words, more than half of the profit I make from that project, we go for what? Go for taxation. Now, would that encourage you to undertake export? Definitely not. Definitely not, because why would I pay 60% of my income because I want to export? When if I'm selling it within Nigeria, I would just pay tax of 30%. So that could actually discourage, when you have incidents of double taxation, in addition to the fact that profit is low, it could actually discourage people engaging in cross-border transactions. So they lose out on that opportunity, and the benefit to that country the resident country, it's also lost. So because of that, it's important that when countries build international tax laws or rules, they also consider what can we do to minimize the impact of double taxation. Thirdly, we're looking at promotion of economic cooperation and fairness. International tax rules will basically ensure to promote economic cooperation and fairness among countries. So by countries coming together to reach an agreement on certain treaties, certain things, they're able to create a level playing field for businesses and individuals operating internationally. So this would help basically encourage some level of transparency, foster cooperation between tax authorities, and ultimately ensure equitable and efficient global tax system. So if you are in your own country A, and you only have data on information in your country, it's become difficult for you to really know what it's earned by that country, by company that is not resident in your country, from your country, because if they're selling to your resident, payment is made direct to the account. So you don't know what's happening there. But when there is cooperation, you can exchange data. So country A could exchange data with country B could exchange data with country A. And that would ensure that there is fair distribution of tax between the various jurisdictions, both where the money is earned and where the business or individual is resident. So those are three key objectives of international tax rules, why companies will typically push for that. Now, when we say it's important that we take a step back and ask ourselves, what do we mean by non-resident? Like I've mentioned before, the default principle on taxation is what? Residence. This is the default principle on taxation, is the residence concept. That's the default principle. And that is what is applicable for most countries. Wherever you stay, you're benefiting from the amenities by the government. You're benefiting from the security that's provided by the government. You're benefiting from the powers, the social amenities, the infrastructure, you're benefiting from it. So wherever you reside, by default, most countries will require that you pay tax, regardless of where you earn that income from. Regardless of where you earn that income from, you should pay tax because you reside in our country. However, countries also acknowledge that the world is a global village. It's important that people, individuals, and businesses that are non-resident should also contribute, because they're earning that income from your border, they're earning that income from a geographical location. So, and that is where international tax is mostly focused on non-resident persons. Now, when we say non-resident person, it's important to know that there are two broad groups. One is individuals, and the second is corporation, businesses. By individuals, we mean that the person that is earning money from Nigeria is not resident in Nigeria. We'll move on to our next topic, which is the concept of residence. We'll look at what it means to be resident in Nigeria and the rules around residence. Sometimes someone comes into Nigeria for a couple of weeks and goes back and stuff like that. So what's the rules around that? So let's come back to what we're saying. So non-resident in terms of means someone that is not resident in Nigeria. And for someone that is not resident in Nigeria, you could earn income through a number of ways. One is you could have a temporary work permit. So we have expatriates coming on temporary work permits, or offer services, not really coming really, offer services from wherever they are on work permits. They earn income from Nigeria, but they are not resident in Nigeria. We could also have some other types of visas, really, besides temporary work permit as well. The other class of visas as well that could grant one the right to earn money out of Nigeria. We could also have individuals not resident in Nigeria, but they earn money from sports, entertainment activities, and the likes. We also have seafarers, platform workers. Some of these guys that work as seafarers, they don't reside in Nigeria, but possibly they're involved in this trade, and they have to earn income out of Nigeria because their ship would basically bring items to Nigeria and then leave Nigeria. So even though they are not resident in Nigeria, fact that they need to bring the ships into the country, they earn income out of that. And then there are also individuals that provide some form of technical consulting, management of professional services, advisory services. For example, a company in Nigeria looking for advisory from a big legal firm in UK. The legal individuals, or not the firm, what kind of individual from someone in the UK, an individual, is not resident, but they can provide that professional service, and that would fall under non-resident individuals. Now, when we say non-resident corporation, a company, we're saying companies that are not registered with the CAC, but they earn income from Nigeria. And this, when it comes to non-resident corporation, there are two main groups of it. One is the fact that the company is not resident in Nigeria, but they have a fixed base or a permanent establishment in Nigeria. We're going to speak a little bit more on what this concept means, but just to explain what that means, and just briefly, when we say fixed basis, this company is not resident in Nigeria, but maybe they just open one office somewhere where, as they're bringing goods in, the goods is being dispatched out from that fixed base, or they conduct their services, their sales through a particular agent in Nigeria. That's the fixed base. We know, so you can always make reference to that office. It's not incorporated in Nigeria, but they have that base in Nigeria. Second one is where you have invisible or virtual permanent establishment, or what is also called as significant economic presence. You don't have a fixed office. So you don't have a physical office. It's not visible, but we know that you are established in Nigeria. And most of these social media will come into place. Most of them, Twitter, Facebook, TikTok, they're not registered in Nigeria. But we know that they operate in Nigeria because they earn a lot of money out of this country. So that's an invisible or virtual permanent establishment because they continue to earn money in Nigeria. So it's important that this group of individuals pay taxation. So these are the two broad groups of non-residents that international tax would be applicable to. Is there any question on this slide that speaks to non-resident individuals? It's important that we understand these groupings.
No, please.
Okay, thank you. So we've spoken extensively on class of individuals that are not resident in Nigeria that are subject to tax. And we said that in addition to non-resident, if you are resident in the country, you must pay tax because that's the default rule. So basically, what are then the rules governing taxation then that we want to really appreciate as we go along with this discourse on international tax? And that is the right to tax non-resident activities. Where do we derive that right as a country to tax non-resident activities? There are three main or broad grouping of laws that empowers the country to tax non-resident activities. One is the domestic laws of Nigeria. So our own domestic laws, our Corporate Company Income Tax Act speaks to taxation of non-resident as well, what the requirement and of non-resident and different activities, economic activities of non-residents, and the tax approach to that. The second is foreign countries' domestic tax laws. You stay in Nigeria, but you're earning income from outside of Nigeria because maybe you're providing freelancing or something. That country has a right to tax your income because they do have their own foreign tax laws that applies to income earned out of their country. So that gives them that taxing right to tax your income, whether you reside there or not. A third area where countries derive the taxing rights is from tax treaties. So by tax treaties, we made agreements between countries. So tax agreements between countries. So let's recap. What are the objectives? What are the primary reasons for having tax treaties? Let's see if we still remember what we discussed. What are the primary reasons for having tax treaties? Why would country A want to have a tax treaty with another country? Let's see if we can recall some of the things we've discussed thus far.
To minimize
And
the
these are,
taxation.
Yeah, someone said keep one of the things. He said double taxation. What else?
trying to tax their global income.
Okay, so second thing is to ensure, let's phrase it, economic cooperation.
To protect the interest of the taxpayer.
Okay, and then to protect taxpayers' interest. And then we also spoke about the fact that it helps prevent tax evasion and base erosion. When you have tax treaty, the other country will provide you with information on what's attainable over there. And so their home country, they provide you with the information they have around the income that country is earning. So you could see when, for example, assuming that you have a tax treaty with the UK and you're looking at a country that's earning income from Nigeria, but when they when they offer service to Nigeria, the Nigerians don't pay into the company's account in Nigeria. Rather, they pay with their cards or what have you to the foreign company's account over there. So unless you have access to that data, you might not be able to have a full picture or a good picture of the income that is coming out of Nigeria. But when there's a tax treaty that enables exchange of information, it's then possible for you to have access to that data, and then you're able to analyze that data and ensure that there is no income leakage when it comes to revenue, taxation of revenue that are derived from Nigeria. So that's the reason why we have some of these tax treaties. And we have about 16 countries that Nigeria has tax treaties with. The country keeps working on increasing the number of countries that they have tax treaty with, because it helps them to increase their tax revenue as well, and they reduce the incidence of double taxation. So these are the tax rights where the country derives right from when it comes to taxation. Now, to support the development of international taxation and tax rules in general, we do have our national tax policy. And so this tax policy basically provides guiding principles for Nigerian tax system. So when they are developing any new tax rules, any new acts around taxation, international tax, these principles would often guide those rules. So they want to look at these principles and say, okay, these rules that we're establishing, does it align with all of these guiding principles in our national tax policy? So the principles are as follows. First is equity and fairness. So whatever tax system, tax rules is established, the government want to ensure that it's fair, it is equitable, it is devoid of discrimination. Taxpayers should be required to pay according to their ability. In other words, the higher you earn, the higher the proportion of tax you should typically pay. Because if you have rules that tax more when you earn less, that's an unfair rule, and it doesn't align with our national tax policy. So that's first principle, equity and fairness. Second principle is simplicity, certainty, and clarity. Any tax rule you're developing should be simple. It shouldn't be one, it should be simple to understand. It shouldn't be one that has to undergo a lot of complex technical review by experts before you understand it. It should be something that an average person should be able to read and comprehend. It should be simple, to be clear and easy to understand. It shouldn't be subject to interpretation. It shouldn't be a rule that if I give Mr. Lawyer A, he's going to tell me this is what it means. And I take that same rule and I give to Mr. B, he gives me an entirely different interpretation because it is ambiguous. So a tax system should be simple, certain, and clear. Thirdly is it should be convenient. So when we say convenient, there are two things that are expected. One is time, and second is the manner for the fulfillment of the tax obligation to take into account the convenience of the taxpayer and avoid undue difficulties. So let's say you're saying, okay, I want taxation. We're trying to look at taxation on a monthly basis of VAT, for example. And you're saying, okay, taxation VAT filing for January for each month should be on the last day, which is 31st of the month. That's definitely not convenient because it will put a lot of pressure on businesses, a lot of pressure. It doesn't give them enough time to be able to do the right thing, put together their records, and then do the appropriate and the right filing. And then the manner of fulfilling that tax obligation as well should be convenient. It shouldn't be one that you have to go through 10, 20 different people to get approval before you can pay your tax. Because once people are stressed to pay tax, what happens? They don't pay. I'm giving you money, and you're stressing me to give you my money. Typically, you just when they are ready, you come and look for me. So key principle there, like we said, is convenience. A tax policy system should allow for the convenience to the taxpayer when it comes to meeting their respective obligation. And then we're looking at low compliance costs. Low compliance costs. What does it take for the taxpayer to render their tax filing and returns? What's the financial implication on them? Do they need to install a massive software, maintain that software? Does it require a lot of cost on their part to be able to make their tax filing and pay? If that is the case, then there's a likelihood that people will not do it, because tax, like we said, is oftentimes self-filing, serve as and you file. I can't be giving you money and then I'll go into stress to give you money. So a tax policy says that whatever tax system you're putting in place, what it takes for the companies to comply should be minimal, kept to the barest minimum, the cost on their part, really. And then the administration as well of tax. The administration of tax. So let me pause here. What's the difference between compliance cost and cost of administration? Let me pause. What do the meaning between compliance cost and cost of administration?
Compliance cost simply means the cost by which you put in place for you to get your unpaid taxes by taxpayers. That's a compliance cost. The ability to make sure that taxpayers pay their due share of the tax for a particular fiscal year. Then the other one is administrative cost. That's the runnings of the revenue authorities within a fiscal year.
Thank you very much. Thank you so much. That's spot on. So when we say compliance, let me just recap what you just said. So when we say compliance cost, we're referring to the taxpayer. How much would the taxpayer have to spend to be able to pay their tax? What do they need to, what expense do they need to incur to be able to file and pay their tax? So that's the taxpayer. When we say cost of administration, tax administrative cost or administration cost, we're referring to the likes of the Federal Inland Revenue Service or the State Inland Revenue Service. What will it cost them to enforce the rule? What will it cost them to ensure they collect what is due to the government? So what will it cost them to collect? And what will it cost them to enforce the provisions of the law to ensure that whatever is due to the government is actually collected? It's important that you understand the difference between this concept. Another principle guiding principle is flexibility. So a tax system, a tax rule should be flexible and dynamic in a manner that does not retard economic activities. And finally, it should be sustainable. You don't kill the cow that you're milking from. You don't kill the cow that you're milking from. You don't implement a tax system that you impose a lot of burden on organization, and then they're able to pay one or twice, and then they're out of business. That's not sustainable tax systems. We want to ensure that whatever tax that we implement should be one that promotes sustainable revenue, economic growth, and development. So the government should be able to balance between the fact that they want revenue versus the fact that businesses need to survive. Businesses need to be able to retain their profit without having to pay everything to the government so that they can continue to generate revenue and they can continue to pay tax, because the more revenue they generate, the more tax they're able to pay. So a tax system should encourage that economic growth and development within the country, which would then support growth. So these are the key principles that guide our tax system. And in terms of our exams, as we go into practice question, we're going to apply the national tax policy. Because oftentimes you'd have a question that brings up a tax rule or a tax system. So you'd have a tax rule, a proposed or a draft tax rule, a tax rule or system. Then you're then asked to assess whether it aligns. You're then asked to assess whether it aligns with the national tax policy. You're asked to assess whether it aligns with the national tax policy, or you're asked to look at the rules, look at the tax system, and then assess what part of the rules or part of the tax system does not align with the national tax policy. So therefore, it's important that we have a full understanding of some of the guiding principles of our tax system. So you can take some of our tax system and then see if you could do some of these assessments. So like we said, quick recap: equity and fairness, simple, certain and clear, convenient, low tax compliance cost, low cost for administration, flexibility, and then sustainability. Now, before we go further, let's do a quick definition of some of the terms that will come across as we discuss international tax. As we go into the course, so that when we see some of these terms, it won't come as a surprise, really. One is some of the terms we need to know, really. One is active income. Active income. So the term active income basically refers to earned income. Whatever income you earn from work, that is your active income. I need to go to work every day. I need to get up in the morning, dress, so I go to the office. So that income you earn from your work is called earned active income. And so this would include taxable, like your income, your wages received for work, self-employment income, participation in partnerships. So if you need to work, the income you earn from exerting physical efforts, that is called active income. And this income, except the specific rules exempted, those income will be subject to taxation. That's the first concept, a term we should be aware of. Another term we should be aware of is passive income. Now, passive income basically means income derived from activities other than your physical exertion of effort. So, for example, you have a rental property somewhere, and every morning you just get up, you tie your wrapper, you go and collect your rent. So that's sort of passive income. You don't need to exert effort to earn money out of it. It's basically out of your investment. So you could have rental income, or you're a limited partner. Your own was just to contribute money, nothing more. You're not actively involved in the day-to-day running of that business. Or you earn income in form of dividends. So that's the passive income. Now, this passive income in form of dividends, sometimes it's classified passive income, sometimes it's classified as portfolio. So sometimes you just have portfolio investment put as a different term. It could also be called passive income. but at some other time, we also have a separate name for them called portfolio income. So by portfolio investment, we're looking at involves your ownership of investment instruments, such as stocks, or what we typically call shares sometimes, bonds, or other financial assets with the expectation of earning a return or experiencing growth or capital appreciation. So that is what a portfolio investment really. The income out of that portfolio investment could be referred to as passive income. We are not actively involved in the management of that business. You just invest and then you earn something out of it. So I'm going to make reference to this term as well a lot as we delve more into international taxation. It's important that we are aware of that term. Fourth concept is the concept of double taxation. And this is a recurring word when it comes to international taxation. So let's quickly recap what it means again. So when we say double taxation, it's basically where that income is subject to taxation twice from the same source. So that same income is subject to taxation twice. And a common incidence of this when it comes to international tax, where you have residence, principal, and then non-residence and income. So the country you are earning the income from would say, this income is earned from our country, we need to tax. Then when you are staying, they would say, wow, you're residing here, so you need to pay tax to us. So that could give rise to double taxation, and that could be both at the company level and at the personal level. Then another concept I want to be aware of, the term jurisdiction. When we say tax jurisdiction, we mean the authority of a taxing state to impose tax. So which jurisdiction, which state, which country has the right to impose tax? And that right will be based on one, the relationship of the income with the tax object, or the taxing state, which is the source, or the relationship to the tax payer based on their residence or nationality. So there are different jurisdictions. So your rights could be in terms of the fact that this income is related to the source. So your taxation is linked to the source. It's generated from our country. So we have that jurisdiction to tax income that are earned from our country. It could be based on residence, because you stay in our country, so you need to pay tax based on what you earn out of our country, or the nature of the transaction, really. Other concept we should be aware of is the concept of source. By source, basically referring to the country where the income is generated. We're not saying where the guy is staying, where he residing, no. We're saying where the income is generated. So that's a tax source. And that's very important for international taxation or non-resident taxation, really. Another concept is source taxation. And source taxation is justified by the notion that the country providing the opportunity to generate income or profit should have the right to tax it. So this is the main reasons why countries would tax income generated from that country, even when you don't stay there. So this is the key reason. This is the key reason or justification. So this is the key reasons / justification for non-resident taxation. So trying to take note of this. Key reason is that the country that is providing you that opportunity to generate income or profit should be able to tax it. That is because if they are not there, you possibly would not be able to generate that income. It's important that that is taxed. Another concept we should be aware of is residence taxation. And I've mentioned it a number of times that for most countries, this is the default tax principle. So this is based on the principles that individuals and firms should contribute to the public services provided by the country where they reside, regardless of the income source. You reside in Nigeria, for example, you benefit from government spending on security. You benefit from social amenities, infrastructure. So the principle here is that because you benefit from these public services, you should be taxed on the income you derived, wherever you derive them, because we provide you with a convenient environment to be able to regenerate that revenue. So these are the key concepts and principles around residence and the justification for non-residents. And then for residence taxation. Important to take note of these two key principles. Another term we want to be aware of is what we refer to as a controlled foreign company. So this basically refers to corporate entities that are registered and conducting businesses in a different jurisdiction or country other than that of the controlling owner's residence. So what we had is the owner is in Nigeria. And you have a company that is established in Nigeria. And this Nigerian company then goes abroad and then possibly acquires another company. So this second company that acquired or has ownership, controlling interest in is called a controlled foreign company. We'll explain as we go along, we'll see why a company would, for instance, incorporate a different company abroad, completely different from what they have in their own home country, and some of the tax planning strategy they tend to want to achieve from that. So those are some of the key terms we're going to make regular reference to. So it's important that we are aware of these terms really in the course of our international tax discussion. So we've talked about international tax treaties really, and we've said that we've looked at the benefit of having some of these treaties. So let's do a quick high-level review of the history of international tax treaty across the world.
Excuse me.
Yes, please, go ahead.
I think let somebody invite Yemi's attention to his camera. I think he's doing domestic things and he forgot. Okay. Yemi Adekoya.
Yemi, would you? Okay, so let's proceed. I think I could stop the video at my end. Okay. Let's proceed. I'm able to stop the video at my end. Okay, so let's proceed then. On international tax treaty, really. So we've said that one of the key issues with international tax is the issue of double taxation. That is one of the key issues around international taxation, the concept of double taxation. And that is because there's a concept of residence, there's a concept of non-residence. And like we mentioned, in the course of our discussion, if somebody is taxed in where he earned the income at a particular rate, and then brings the money into his own country, is also taxed on a different rate without considering tax he had paid before, where they earn the money, it gives room for double taxation, and that could discourage foreign investment, that could discourage economic growth, really. And so over the years, a number of countries have tried to make certain progress towards eliminating double taxations. One of the ways they do this has basically been through one of two ways. One is bilateral conventions. Two countries come together and reach an agreement to say, okay, between your country and my country, this is the agreement we reached for transactions between us. We're going to look at some of these things that are being done as we go along, just to ensure that we reduce the possibility of double taxation. So that's one approach. The second approach is to adopt the unilateral measures by the Organization for European Economic Cooperation. So this organization brings out a number of recommendations which some countries choose to adopt. Countries that adopt those taxation do that because the provision of that rule helps to reduce the possibility of double taxation. Tends to reduce the possibility of double taxation. So there've been a number of countries that have been involved in bilateral agreements, and the countries too are now members of OECD. And the work they've done generally been very impactful, and it's helped support global transactions. It helps to prevent international double taxation. And the body continues to make progress and continue to bring up a number of other supporting documents to help countries reduce possibility of double taxation. Nigeria, for example, even though not a member, we do adopt some of the principles of OEEC. And we're going to speak to some of these principles as we go along. So we've mentioned it before, but let's quickly look at it again. What is the main thread around double taxation? What are the factors contributing to it? We've said two things really. We've said issue of conflict between residence and source jurisdiction. Source, like we mentioned in our definition of concept, is where the income is earned. And then residence is where you stay. So whether there's that conflict, in other words, where you earn income is not where you stay. That's what we mean by conflict. There's a risk of double taxation of your income or your profit. Another thing would then be, sometimes we have divergent definitions of a number of connecting factors, which we'll speak about in the course of our discussion. So those are two quick areas that could impact on and could lead to double taxation, and also impact on international taxation as well. Now, for a number of us that are doing the CITN exams, our objective is because we want to be tax practitioners, or we want to pursue a career in the tax field. And so it's always important that for professional levels of our exam, for all of them, it's always important to do a recap or a reminder. I think it forms part of all the syllabus at the professional levels on ethical issues in taxation. So you're going to come across this in most of your topics, really, ethical issues in taxation. And so there are 5 fundamental principles of ethics as specified by the International Ethics Standard Board for accountants that serve as an important guiding principle for anyone that wants to be a tax practitioner. So we'll do a quick recap of these guiding principles, really, because they're going to come, like I said, you're going to come across in a number of places. One is integrity. So as a tax practitioner, it's important that we deal fairly and truthfully. In other words, our activities should involve fair dealing and truthfulness. A professional accountant involved in tax practice should not knowingly be associated with any report, returns, or other information where the accountant believes that that information contains a materially false or misleading statement, contains statement or information that is provided recklessly, or omits or obscures required information where such omission would be misleading. In other words, recap means that as a tax practitioner who is an accountant, our dealings should be truthful and fair. That's the key ethical principle that we should bear in mind. Second ethical principle as tax professional is objectivity. A tax or accountant shall not undertake any activity if its circumstance or relationship unduly influences the accountant's professional judgment regarding that activity. So if we have to do any activity, any tax work or any tax review on accounting related issues, where we know that what we do will be influenced by the relationship we have with the other party, or will be influenced by that particular circumstance we find ourselves, we want to avoid that situation. Take, for example, that let's take a typical example that one is a tax auditor, an example, with maybe state internal revenue service. And then you ask, as part of your work, you're meant to audit, and the person you are meant to audit at this point happen to be your dad or your mom. So what would typically happen in that situation? Would you be objective? What do you think?
There's a means of connecting factors there.
Thank you so much. Thank you. Thank you. So we need to then look at the situation and say, is this something we want to do? Or do we want someone else to take it on? It's a requirement of our profession. We need to be objective in our work. The third guiding principle is competence, professional competence and due care. Professional competence and due care. There are two different things though. One is professional competence. A second is due care. I'm sure we've come across this concept in a number of places as accountants and even as in an exam up to this level. So let me pause and ask, what's the difference between the two? What's the difference between professional competence and due care? Who wants to give it a try? Or maybe I will rephrase, is it possible to be competent, professionally competent, and then not undertake due care in carrying out our work? Maybe I should rephrase it that way.
Okay, yeah. Professional competence means that you are doing things in accordance with the guiding principle of one's profession, and there's no way you'll be professionally competent and you won't exercise some due care in your assignments. My viewpoint.
Okay, so what you're saying is that if you are competent, you would establish due care. That's what you're saying?
Yes, please.
Okay. Okay, let me wait if someone else has a different view. I don't entirely agree with that. Okay, any other opinion? I'm sure we'll say yes. Okay, go ahead, please.
Yeah, you can be professionally competent in execution of your duties in line with the subscribe of your professional body. But exercising due care might be against the dictates of your professional competence, because due care, you owe it to your employer. Professional competence, you owe this to your institute.
Okay, so let's break the terms together. When we
that's
say, Oh, thank you very much. Thank you so much. I appreciate that. Thank you very much. So let's break it down now. When we say one is professionally competent, we mean one thing, basically that one has the professional knowledge and skills at the level required to do a good job. In other words, you are competent, you have the knowledge, and you have the skills. You have the knowledge, you have the skills to get a good job done. But when it actually comes to doing the job, when it now comes to actually doing the job, do you act diligently? That is where due care comes in. You might have the knowledge, you might have the skills, but when it comes to doing the job, you just rush through it. You're not exercising due care. In other words, you are not acting diligently in accordance with the knowledge and skills you've acquired. You might have the knowledge, you might be competent, you have the knowledge, you have the skills. That is, we are competent, but that doesn't translate automatically to being able to act diligently. And that's why sometimes you see some people that they have the knowledge. So if you tell them, oh, come and explain all the IFRS standards to me, they will give you everything. They will unload everything to you. They explain everything to you. They have the knowledge. They have the skills. When you now give them documents and say, okay, now I need you to prepare this account for me, put this thing together for me, they might be struggling because they don't have that. Even though they have the knowledge and skills, they're not able to act diligently, carefully, take their time to get the job done. That is the difference between the two. So one can be competent, you could have the knowledge, you could have the skills, but when it comes to the work itself, you don't act diligently. And when you don't act diligently, you're not exercising due care. So as an accountant, we should not only have the knowledge and skills, but we should also act diligently. So that is the third principle we should take note of. A fourth principle is confidentiality. Tax practitioner, you're going to come across, you have access to a lot of information. Information on the company's financials, information around board meetings, discussions, really, just because you're looking at something around taxation, really. And all of this information, you actually have access to them by virtue of the work you do. They are not public information. So as professionals, it's important that you keep this information confidential. So one of the two key principles we should note around confidentiality is one, is that we do not disclose. So if, for example, you do a review of company ABC and you've seen some information of what's happening in that company, you wouldn't want to go out with your friends over a drink and then you're done telling them everything. That would be a breach of the confidentiality principle. So do not disclose. Second key of confidentiality is do not use for personal gain. Do not use for personal gain. Let's take a typical example that in the course of doing your tax audit, you discover that maybe Bank A, because you have access to a lot of information, is planning to launch a new product. And that new product is going to be a bomb. It's going to be a very unique product. It's going to be one that people are going to go for, that will increase revenue. The projection looks very lovely. You decided not to disclose because you know very well that the confidentiality principle for accountant says you should not disclose confidential information. But what if you decide to make use of that information for your personal gains? For example, you decide to quickly go and buy the shares of that company because you know that immediately that information or that product is launched, people are going to rush for it, the price will then increase, and then you make gain. by taking that action, you would also be breaching the confidentiality principle. So whatever information I come across, so do not disclose, do not use for your personal gain. With that said, there are exceptions. There are situations where tax professional, the professional accountant might be required to disclose confidential information. And that situation would generally be grouped into three broad categories. One is where disclosure is required by law. There is a court case, and that court case points to the fact that as a tax auditor, you have done some review. Please come and provide evidence around this particular matter. In that situation, you will not be in breach of the confidentiality principle if you disclose what you know, because it is required by law. Second is if the disclosure is permitted, not required. Required means mandatory, but this time it's permitted and is authorized by the person you get, the source of that information. Sometimes somebody, or maybe the business is going to be sold and the other party is interested in certain information because they know you undertook a review of that business, and they seek the permission of the owner of the business for that information to be disclosed. And that request is authorized by the client. So in that situation, you are permitted to disclose. So that is the second scenario where we could reach a confidentiality obligation. A third is when there is a professional duty or right to disclose. When there is a professional duty or right to disclose. As accountants, one key principle is that we act in the public interest. We act in the public interest. What does that mean? Let me just pause. What does that mean? What does it mean when we say we act in the public interest? We act in the public interest. Who wants to give it a try? I'm sure we had it stand before. What does it? What could it possibly mean? Acting in the public interest. Okay, so when we say we act in the public interest, we basically mean that our actions should be for the greater good. Our actions should be for the greater good. So let's take a typical example. You're undertaking a review in a pharmaceutical company. And in the course of your review, you discovered that the drugs they sell are expired drugs. Expired drugs that are repackaged with falsified future dates. So you find that expired drugs that are repackaged with falsified future date. You get that information in the course of your audit. Or then you discover that there is a confidentiality principle that says that you don't disclose information you find in the course of your work. So what is the right thing to do in this situation? Will it be right to say, I'm not going to disclose because there is a confidentiality principle, or what is required of us in this situation? What do you think? What do you think would be the right thing to do? Even though we know that the code of ethics says you shouldn't disclose. Okay, so what is the principle? Why would you want to speak out?
In order to save lives of citizens.
Okay, so that is the concept of acting in the public interest. So if any disclosure or keeping quiet on anything will negatively impact more people, a lot of the public, then we are obligated to act in the interest of the greater good. So in that situation, it's important that we take steps to inform the requisite authority. Oftentimes, what we recommend is that you are well protected, try and seek legal guidance, try and seek some legal opinion first on the matter, then we'll then be able to know how to proceed with it. But where you have this kind of situation where there's a threat to the greater good, important to act in the public interest. And that is where there is a professional duty. Acting in the public interest puts on us the professional duty to disclose. And some of these things could be because of the situation where you need to comply with certain quality review, certain inquiry, investigation, or based on our findings in the course of our review. So those are 5 key principles that we should be aware of when it comes to code of ethics. Now, what of a situation where there is a conflict of interest? In other words, a situation where the taxpayer has an obligation, but then there's possibility of making certain personal gain if you look the other way. Let's go back to the situation where you, as a tax professional, you're meant to be a review of, say, your tax review of, say, your dad or your mom. There's a conflict between, should I act in the interest of my family? Should I act in the interest of my profession or my employer? So where there is that conflict, either in personal situations or in exam situation, it's important that the taxpayer should take steps to resolve the conflict in complying with these fundamental principles. So what are some of the steps the taxpayer could take? One is document the issues, details of any discussion held, and disclose that issue. So you could say, okay, these are the issues. Disclose it to your employer or your boss to say, oh yeah, I know I'm meant to do this, but I do have a personal interest in this matter, and I'm communicating to you what my interest is on this matter. Now, if after reviewing it, and then it's determined that you can still go ahead because the trade is not as significant as you think it is, that's fine, you go ahead. Possibly, but then you would have documented it and it's well done. And if you decided that someone else should take it, well, that can happen. But in a situation, certain situations become difficult for you to resolve it in that way. For example, you're doing a review and maybe even your own business is involved in a highly unethical activity that you know very well that it's difficult for you to resolve internally, because definitely your business will not want you to disclose that information to the general good. So before you decide to take any action, you don't just go out and start saying, oh, I went to company A, their dog is expired. I went to company A, their dog is expired. Tell everybody you find on the road. That's not what is expected of us. So in that situation, we're expected to first begin by want to seek professional advice. And this professional advice could be from a professional body. So we could reach out to a professional body, CITN, ICAN, just to seek for guidance on this. We could also seek guidance from legal professionals. So let's get their thoughts around what should be the best approach on this particular issue that we've discovered. So why do you think it's important that we seek legal advice? Let me pause. Why do you think it would be important that even when you find something that is not ethical, before you seek action, that would seek legal advice? Why seek legal advice? Who wants to comment on that? Why is it important? Because some of these things we discuss might come across them in the course of our career. So it's important that we get to appreciate why some of these things need to be done. Who wants to try that out? Why should we seek legal advice?
Okay.
Situations where you can't resolve internally.
For you to seek legal advice, at the beginning of the engagement you may have done, you would have signed an oath of secrecy, which may be binding on you not to disclose what you've seen. So you need legal to guide you through before you make such a disclosure if an understanding is not reached.
Thank you very much. That is very correct. You want to be sure that you are protected. You want to be sure that any action you take, you have the protection of the law, and that there will not be any adverse consequence on you in terms of fines or penalty just because you're trying to do something. You feel you're trying to do something good, but then at the end of the day, you find out you're in bigger trouble. So you want to ensure that we're protected as professionals. So it's therefore important that in such situation, we tend to look for legal advice. Very important. Now, if after exhausting all relevant possibilities, the conflict remains unresolved, the tax practitioner shall, where possible, refuse to remain associated with the matter creating the conflict. So if it has to do with a particular engagement, I want to say, okay, I don't think I'm in a position to continue with this, or I don't want to be a part of the team involved in this particular activity. So those are the steps tax practitioner would want to take where there is a conflict. It's important that we know these 3 steps for our exam purpose, and how could it possibly be tested? One option is direct your question where we're saying, okay, what step would the tax practitioner take where there's a conflict of interest? The second scenario is where we have a case study, a little story, and then we're asked to advise the tax practitioner on the action they should take with regards to the matter. We're going to look at some of these when we start looking at practice questions, but it's good that we appreciate some of these things and why it's coming up at this point in time. Now, when it comes to taxation, international taxation as well, there are 2 other concepts that is important to get to know as part of our introduction into international taxation, and that is taxation of inward and outward investments. Now, when we say inward investment, we're saying investment made by foreign individuals or businesses into a country. So an individual is in the UK, resides in the UK, doesn't reside in Nigeria, but then he decides to invest in Nigeria. That is inward taxation. Now, when it comes to development of international tax rules, as it concerns inward investment, a key principle most tax countries will bear in mind is what is called capital import neutrality. Capital import neutrality. So what do we mean by capital import neutrality? So this concept, as you're developing your international tax rules, this concept aims to promote equal treatment of domestic and foreign capital by ensuring that the tax system does not favor or discriminate against either type of investment. In other words, we don't want to say, if you are a Nigerian, you establish business in Nigeria, your tax rate is 10%. If you are a foreigner, your tax rate is 30%. That is discriminatory. So most tax organizations are tend to apply these principles around import neutrality to ensure that we don't have this discrimination, that the tax rate that is taxation is applicable to those that invest locally would also be applicable to those that bring in money to invest in the country. And that encourages investment, it encourages foreign investment into your country when they know, when those that bring in their resource know that they are treated the same way that those around treated in terms of taxation. Now, to achieve capital import neutrality, there are a number of approaches that countries would adopt in their international tax policy. Let's look at some of them quickly. One is elimination of discriminatory tax provision. We explain this. So basically, countries will strive to remove any tax provision that would treat foreign investors differently from domestic investors. So they want to eliminate things like preferential tax rates, exemptions, and the like. So that's one approach. The second approach is to get involved in tax treaties. But like we said, tax treaties would help you reduce double taxation burden. So most countries would want to ensure that they go into as many tax treaties as possible so that it will protect those that are coming into the country and reduce or prevent a possibility of double taxation. And where tax treaty is not possible, some companies offer what is called a foreign tax credit as a mechanism to avoid double taxation for residents who earn income from foreign investment. And so what it basically does is that it allows taxpayers to offset any tax they've paid in foreign jurisdiction against their own domestic tax liability, ensuring that income is not taxed twice. So what do we mean by that? So for example, you're a Nigerian, you earn income, in say the UK. So let's assume that you earn in the UK converted to Naira. Let's keep it very simple. Converted to pounds to Naira, it comes out to be 1 million. And because you earning this income in the UK under the non-resident tax rule, you pay a tax of say 10%. So you are paid 100,000. So let's say when you bring that income into Nigeria, because the concept of residence is the default rule. You pay tax where you reside. That's the default rule. So let's assume that in Nigeria, you're meant to pay a tax of 30%. So that would basically be 30% of your 1 million. So that would be 300,000. Now, where there is no tax treaty and there is no foreign tax credit, what will happen is that you would pay 100,000 in the UK, pay 300,000 in Nigeria, and that leaves you with 600,000. But in a situation where we have a foreign tax credit, what would then happen is that, okay, we calculate our tax in Nigeria and say, okay, in Nigeria, you are meant to pay 300,000. But you had already paid 100,000 in UK because you earned the income in UK. So let's give you a tax credit for that 100,000. So by the time you deduct that 100,000 from 300,000, gives you a net of 200,000. So this then becomes what is payable in Nigeria after providing for what you had paid where you earned as a tax credit. So that tends to reduce the possibility of double taxation. So that's another approach countries will take where there are no specific tax treaties. And the fourth is to ensure equal treatment of investment income. So capital import neutrality involves treating investment income, such as your dividend, interest, capital gains, in a non-discriminatory manner. This means that foreign investors should be subject to the same tax rates and rules as domestic investors when earning income from investment. So these are the key policies that we incorporated, the companies try to incorporate into the international tax rules to reduce possibility of double taxation and tax burden, and to strengthen their tax system. So just like we're concerned about inward investment, in other words, somebody coming from outside Nigeria to invest in Nigeria, so also people investing outside of Nigeria are also concerned about double taxation and tax burden. That is what we refer to as outward taxation of outward investment, or capital export neutrality. That is basically investment made by residents or businesses of a country into a foreign jurisdiction. So the principle of capital export neutrality seeks to ensure that the tax treatment of investment made abroad is equivalent to the tax treatment of investments made locally. So it attempts to eliminate tax-related biases or advantages that may discourage or distort investment outside of a country. Because people feel that they are going to have a lot of tax burden going outside of the country. They'll just stay inward. And the implication is that you won't be able to earn FX because they are not exporting. So as part of our international tax policy, we want to see how far we can incorporate capital export neutrality into our rules. And what are some of the principles or approaches that countries will typically take? Let's look at some of them. We'll still come back to them in detail later on. One is deduction for foreign taxes. So just like we had for foreign credit, tax credit in that import, we could also have deduction for foreign taxes. So countries may allow residents or businesses to claim a deduction for taxes that are paid to foreign jurisdiction on income earned from foreign countries. So I think we've explained that really when we talked about import. It should have been the other way when I was discussing import, really, when I was discussing capital import neutrality. Second is tax deferral. So sometimes some countries would say, okay, just to give you a little bit of break, we'll look at the timing of when you pay tax. It is not when you earn the money that you pay tax, but we're going to allow you to pay tax only when you are able to repatriate that fund back to the country. So it gives the companies some form of break. And because sometimes you might earn money abroad, but it becomes difficult to repatriate. So you can't be paying tax on the money you're not able to repatriate. So they say, okay, when you repatriate, we'll charge you tax. So that is tax deferral. Third, it's on exemption or reduced tax rates. So when we're not able to get certain tax treaty, you can then say, okay, let's give certain reduced tax rates, so that by the time you add the tax abroad plus reduced tax rate, it provides a form of comfort to a taxpayer. And that's why in Nigeria, for example, if you are exporting, there's no VAT on it, because we want to encourage export. I want to ensure that we're able to reduce the overall tax burden on the taxpayer. Fourth approach is a tax treaties. Like we've said, bilateral agreement between two countries play a very important role in achieving capital export neutrality, because it basically prevents countries from double taxing between themselves, and while ensuring that there's fair distribution of the revenue between both where the country is earned and the residents of the taxpayer. Some of those tax treaties, some of them tend to have some agreement rates between the two countries, really, just to support themselves and ensure that they support cross-border trade. And so it's important that we have these principles incorporated into our tax laws, really. The incentive for investors to act in this way, very important, because where the home country imposes relatively high tax rates compared to the tax rate imposed in the country from which the income is derived, tend to create a form of disparity and discourages foreign investment. So those are principles we want to bear in mind when it comes to export and import, and some of the guiding principles on international tax, some of the guiding principles regarding international tax policies. Now, the key area really that has been of interest to most countries is the taxation of digital economy. Most international businesses are earning billions and millions of dollars from countries where they don't reside. So the likes of Facebook, TikTok, Twitter, and the like, they're earning a lot from Nigeria, for example. So that creates challenge around being able to tax different entities. And because, like we said when we explain our concept, the country provides that that opportunity, that environment for you to be able to tax them. So they should earn out of the revenue that you're charging, really. So when we say digital economy, we're looking at a wide range of activities that are conducted via the internet. So such as our e-commerce, online advertising, digital services, digital goods, streaming, data-driven business models, and the like. Like we said, these activities would often transcend traditional borders. Those organizations don't stay in your country. When they earn money, the money is going directly to them over there. So this could be a challenge for tax authorities to effectively capture and tax the economic value generated by those countries, by those entities. And so the taxation of this digital economy raises a number of key considerations, which the tax authorities in Nigeria have been trying to address through a number of policies, a number of reviews, and engagement with stakeholders. But first, let's look at some of the challenges of taxing digital economy. One is the concept of nexus and permanent establishment. Traditional tax rules are based on the concept of physical presence or permanent establishment in a jurisdiction. If you have a presence in a country, it's easier to tax because we know where the office is. So for example, we say you have an office in VI, we can come to your office, assess you, do our review and tax you because you have a residence, you have a permanent residence, what is called nexus. Now, but it's a challenge where these companies, this e-commerce, these digital companies don't have any form of presence in terms of physical presence. And so the tax authorities in this situation face the challenge of determining when and where a digital company should be subject to taxation based on its economic activities and the user base. And that is because where are you going to get it from? Where do you want to get data on the number of businesses in Nigeria that are making use of Facebook and are making the amount that Facebook is earning out of it? You can't get it because these guys are not in Nigeria. Their server is not in Nigeria. Their server is not warehoused in Nigeria. So it becomes a challenge to be able to access that data. So that's one of the challenge around taxing digital economy. Second is being able to determine value created and attribution. In digital economy, value is often created through collection, analysis, and use of data. And this data, we don't have access to it. So being able to determine the value that's been created, it's quite a complex task. So that's really a key issue, really, when it comes to taxing this digital economy. The third one is the fact that these transactions are cross-border. So most digital businesses operate cross-border, multiple transactions across multiple jurisdictions. So this makes it difficult for you to track and tax their transactions. So you have an account where what goes into the account is income from everywhere. So you have earnings from Nigeria, South Africa, Ghana, Togo, going into that same source. So being able to get out to track specific transactions for your own country becomes difficult. And that's why sometimes it makes it easier for them because they know it's difficult for you to track if they don't give you that, if you don't have access to that data. It becomes easy for them to be able to shift profit or be able to give you wrong data around income earned out of your country. And so traditional tax rules really does not adequately address some of these unique characteristics of the digital transaction. And this leads to some concerns about tax evasion, base erosion, and profit shifting, which will potentially lead to loss of revenue for the tax authority. Really, they are meant to pay tax because they earn money out of Nigeria. They made that money out of Nigerians in Nigeria. But where you don't have access to the data on what they are actually earning. So on what basis are you going to make, are you going to assess and tax them? And even when you decide to say, oh, self-assess yourself, what if they decide not to do it? They don't have an office in Nigeria you can go and shut down. So that poses a big challenge. And so because of this, some countries trying to look at some of these digital services and then look at how they can actually tax them through what is called significant concept of significant economic presence, which we'll discuss further. So what are some of the steps that have been taken to address this challenge? Because it's a challenge really. And that environment too, a lot of money that is being earned out of it. A lot of money is earned out of it. A lot of those Facebook, Twitter, and the likes, they declare billions. We know very well that a big part of that comes out of Nigeria. So what is being done to tackle some of these challenges? One is the review of our tax laws. For example, Section 13 of CETA speaks to the concept of permanent establishment at fixed base. So, the OECD rule provides some guidance around this, what a fixed base is and how to impose tax around this space. So even though Nigeria is not a member of this group, but they tend to apply the principles in that body of work by expanding the definition of a tax base as contained in Companies Income Tax Act. So we're going to look at some of those adjustments that are made in the course of our discussion, really. The second approach has been adopted, is adoption of creative approach through innovative tax legislation. So there's a need to look at this, and we continue to, as a country too, we continue to look at what other countries are doing. We continue to see how we can make changes to adopt to improve our tax law. And that is why we would often have our Finance Act, our annual Finance Act. So one of the things the Finance Act would typically do every year would be to look at the tax law and say, okay, what are other people doing to take advantage of the volume of transactions and income that is generated from the digital space? Then we try to make some changes in our laws on an annual basis and taking a cue from other countries that would help us to be able to generate more from the digital economy. We're also looking at, as a country, automating our tax administration. So there's a tax program that the FIRS has adopted, and this is basically help to automate some of these tax processes for foreign countries. So they could self-file without going through a lot of stress and the bureaucracy of having to speak to someone and things like that. Most state internal revenue service too have also been automating some of their services as well. I know recently too, the FIRS, for example, recently modified its VAT filing process. So some of these things are being updated just to ensure that tax system is automated and it helps make it easy for players in the digital economy to file and pay taxes. But like we said, if your compliance cost is high, they won't even bother complying. But when you make it very low, they would say, okay, let's do this thing. Because it doesn't take us, it's not too stressful to get it done. So that is what tax administrators have been doing in the country. Another key success factor when it comes to tackling digital economic taxation is data handling. So there've been a lot of collaborations and tax treaties that look at how we can then collaborate with different countries to get data to support taxation. That's because that is a critical success factor in the taxation of a digital economy. If we don't have access to what they are earning, how do you want to tax it? That makes it difficult. Strategic partnership with different digital economic service providers is another way. Then the ratification of different agreements, multilateral treaties, conventions, different tax treaties, just to ensure that we're able to reduce the possibility of profit shifting and tax evasion. Some of these tax treaties is such that we're able to get data from the country where that company is registered and where they are resident. So just imagine that we're able to get data from US on Facebook transactions. That will enable us to extract from their database transactions coming out of Nigeria, and then they're going to tax appropriately. So those are some of the activities that some of these tax administrative authorities are trying to explore to be able to tackle the challenge in the digital economy. And as you guys also come up, become tax practitioners as well, we hope that we'll also have some other ideas on how we can be able to fully get our share of the revenue from digital economy. So those are some of the approaches that are taken and some of the recommendations to address the challenges of taxing a tax authority, because that remains an area where there's a high level of income leakage, basically because we don't have access to the data. Two, we don't have a base in Nigeria. So we can't go and we don't have where we can go and sit down and say you must file or we'll shut you down right now. We don't have that available to us. So we need to just keep exploring the available opportunities to expand our tax net and they continue to get revenue to support growth and development of the country. Okay, so that's our quick topic around first domain on the international tax policy. So we'll take a pause now to do a recap and then take question on what we've discussed. So what the key takeaway for you? Let me start from that. What the key takeaway for you from our discussion for today when it comes to international taxation? Let's start with that. What are the key takeaways for you from our discussion on international taxation and international tax policies? I'm on a pause. I'll be speaking for a while. I'm on a pause for you guys. What are the key takeaway for you from what we discussed today? Who wants to start? Hello? Okay. Yes, please. Inka, please go ahead.
Okay. Thank you so much for the insightful lecture. I must really comment, sir. And for me, from definition of international taxation, the policies, the objectives, talking about the OEEC and the OEDC, what their policies could have brought about increase in taxation, international taxation, and looking towards the ethics of professional standards. That's one. And most importantly, the residence rule that bring about the international policy and international taxation generally, and getting to know that the source of income or the resident rule and place of significant presence to matters when we're trying to distinguish between the non-resident rule, where you're able to split between individuals and complaints, that the complaints that are not incorporated with CAC. So we have the tangible, that is the visible complaints that have physical structure in a jurisdiction, and the one that we have non-physical presence, that is, they don't have their physical structure. However, they have a place by which they do their transactions, but they don't have physical structure here in Nigeria. Then moving down to the last part where you talk about the taxation of digital economy, which is very, very complex. And Nigeria to trying to see how we can also tap from the revenue in the digital space. And I believe that with that, we'll have our share in the digital economy. So that's my recap for today, sir.
Thank you very much. Thank you very much. That was quite comprehensive. Thank you so much. Okay, so do we have any other question or comment on what we've discussed so far? Now I'll do my own 1 minute recap. Okay, so for me, 1 minute recap what we've done. We've said that one, very important to note that, so I think I should get a sheet here. Okay, so recap for me, an expectation for this course going forward. One, it's very important to note that the default tax principle for most countries is residence. We're going to explain what residence means and the requirement for you to see someone else residing in a country as we go on in the course of our discussion in our next session. But the key principle is that the default is residence. Where you reside, you should pay tax on what? Not just the income you earn in that country, but your what? Your worldwide income. So both internal and external. So that is pretty straightforward. Everything you earn internal and external, you pay tax on it. Second concept is the fact that we said that because of the concept of globalization, your income is not determined by where you reside. You could be anywhere in the world and earn income from anywhere. And that now introduced the concept of non-residence. And we're saying that if you're a non-resident and you earn income, we should be able to tax you on income you derive from our country. We should be able to tax you on the income you derive from our country. And we went ahead to describe and as well as in terms of corporation, what it means. Now, but this student creates a problem because there is a possibility of what? Of a conflict. That where you reside is not where you're earning your income from. And so because you reside somewhere, you must pay tax. And because you're earning money somewhere, you must pay tax. It then gives us a challenge of a possibility of double taxation. Double taxation. Now, the concept of double taxation then comes with a number of challenges. Concept of double taxation then comes with a number of challenges. One is the fact that when people are aware that they would tax twice, you pay 30% somewhere, you pay 20% somewhere, you don't get any form of relief. What happens is that they start thinking of ways not to pay. They start thinking of ways not to pay or illegal ways to reduce that tax. And so it therefore means that it then begins to breed tax evasion and profit shifting. It then begins to breed tax evasion and profit shifting. It then begins to reduce cross-border investment. It then begins to reduce cross-border investment and its associated benefits, such as FX inflows and investment. So it then begins to breed these challenges. Now, to address these challenges, companies need to come up with what? International tax policies. To address these challenges, countries to come up with international tax policies. These international tax policies, we've said, are guided by principles. And we've discussed some of these principles in terms of, for us as a country, our national tax policy has principles. If we're looking at internationally, it's principles around inward investment or capital import neutrality, principles around capital export neutrality as well, so the principles around capital import neutrality, and principles around capital export neutrality. We discussed some of the actions, some of the policies that countries could adopt to be able to tackle these things. And then finally, talked about, which is what? Taxation of digital economy. We talked about the challenges and then what has been done. Actions taken to address these challenges. So that's been our discussion for today. So in the next session, we're going to move further, talk about the concept of residence. What does it mean to say someone has resided, is a resident of a country? Must you be there throughout the year and stuff like that? And how do you define what residence is and the like? So that was the end of our session for today. If there are no further questions, I guess now would be a good time to end the class. Thank you very much, everyone. So I'll share this note to the WhatsApp group, then we'll take it up from there. Thank you.
Thank you.